It certainly looks like they're going to do the 25 unless they want to surprise the market. And if they feel the market needs to be surprised, they could do 50, but there's no indication that we need the surprise. 20 is just fine. The rate decision's the least interesting of everything on Wednesday. There are three other things to look for. The first is the post-meeting statement. How many dissenters are there? How many members actually wanted a 50 basis point rate cut? And are there any dissenters that didn't want any rate cut at all? We think there will be some populations of both. Then you also have to look at the summary of economic projections. Does the group feel they need to do 3 rate cuts this year, or are they still at 2, and did they put 2 into next year? And then lastly, the press conference should be a lot of fireworks because the independence of the Fed will certainly be asked there. So it's going to be a very good Wednesday.
How much do you see the presence of Stephen Miron, if he's confirmed by the Senate later today, and Lisa Cook as materially affecting what impression the Fed's going to be giving markets with the details he just talked about?
Well, that's a really good question. And certainly if Miron makes it to the meeting on Wednesday, he's already missed being able to submit for the summary of economic projections. Those submissions need to be done by Friday. It would have been interesting to see him submit and see if there are some dots down there at 0 to 2% down the road. Instead, I think he's going to make for a lively debate. He's clearly been nominated by the administration to be the voice that says rates should be a lot lower. Is it 1%, 2% lower? Who knows? So that's going to be lively. And I think also everything that's going on with Lisa Cook is a bit of a cloud over the Fed. But the Fed, when they get behind those closed doors and start debating what they should do, we have a lot of confidence in the integrity of the Fed. So I think those are mostly noise around the edge. Interesting for us observers to watch, but I don't think it's going to change much of the Fed's decision-making process.
You don't think investors need to position for a more politicized Fed in 2026?
Well, I've always believed that central banks are politicized because they are political appointees. And no one has been looking to appoint the next Paul Volcker for decades. So everyone's looking to appoint somebody who will help underwrite the economy in the region a particular central bank is operating in. I think that's one thing. I think trying to remove central bankers becomes something that's different. But I give the central banks a lot of credit, the Fed in particular, for just going about its business, looking at the data, trying to make the best decisions with the information they have.
Do you think that markets have correctly priced the challenges that are facing the Fed going into this week again? I mean, looking particularly at the long end of the Treasury curve, of course, the least affected by Fed decisions. But, I mean, we're way back down from the 5% level that we were nudging up against not so long ago.
I think the markets have absorbed it pretty well because there's still a lack of clarity on what tariff policy looks like. And when we look at the labor data, what we see in the labor data is corporate America that's effectively been frozen and put on pause because they don't know what tariff policy is going to look like. So they're not necessarily hiring, but they're not firing either. That's difficult for the Fed to weigh because right now they're seeing higher prices and they're seeing some softening of the labor data. And they're telling us today they're going to value concerns over the labor data more than they are inflation. But it is a real challenge for them.
How much is priced into the US dollar at this point in terms of the risks around further dollar weakness as we look for potentially more easing from this Federal Reserve beyond September?
I think we've probably seen half of the dollar weakness from the peak that we're going to see. We feel there's a bit more to go, probably less on de-dollarization and selling dollar assets, and more just on portfolio rebalancing. As I talk to our clients globally, they've become a little lumpy in their allocations to dollar assets. They recognize that. They're starting to look at places that they'd overlooked in the last couple of years, emerging markets in particular. And they're also looking at Europe again. particularly in the bond market. So I think the dollar has a bit more downside. Think we've seen a fair amount of it, but I think it's just simply portfolio rebalancing.
And Bob, while you're in London as well, I'm keen for your views on the Bank of England. We're not expecting a movement from the BOE this week either, but they have a very different set of dilemmas facing them to the likes of the Fed.
Yeah, they've got a budget to sort out, which is a huge issue in the UK. And it's, again, another one of these unsolvable riddles. You can't really raise taxes, and where are you going to cut spending except on the big essential blocks? So you can't really do that. And I think that's a problem for the bank to navigate around. I know there's some expectation that they'll try to cushion some of the downside with rate cuts in here before year end. Our expectation is they do cut rates again, but not until the spring.
Do you think markets are going to be pricing in more risk premium into UK assets then, in and around the budget?
I think they have to. I think a bit more. I think what's moderated the amount of risk premium in all bond markets has just been the absolute amount of cash on the sidelines. There's a lot of that COVID era money still sloshing around in the system. A lot of it sitting in deposit accounts. You could look at M2 in the US or UK. You'll see that they're setting new indoor records. All of that is looking for a place in markets to go. So that's why backups get bought.